right, good afternoon, possibly good morning, depending on where you're listening to us from today. I want to welcome you to another great educational offering we have here today at Advanta IRA. We're going to be talking about multifamily investing trends for 2024. I have three guests who are going to join me in just a minute from JT Capital and start to go over what those trends look like as we head into the new year. My name is Scott Maurer. I'm the Vice President of Sales for Advanta IRA. I've been with the company for a number of years, led a number of these different educational events, and I'm happy to have our guests on today to talk about their expertise in the multifamily arena, what it means for you, what it might mean for your retirement account as you look for other possible investments inside of your retirement account. If you have any questions about self-directed IRAs, my contact information is here on the screen. So if you want to chat with me about the Roth IRA, a traditional IRA, the different types of investments, some of the rules, please don't hesitate to reach out to me either, again, via phone, by email, whatever might work best for you. And another reminder, as you listen to the presentation today, there is a question box on your go-to control panel or your go-to webinar control panel. So any questions that you have during the presentation for either myself or one of our presenters, please get that typed into the question box, and we'll make sure that we get those answered as we move along, or maybe have some of the questions held at the end. Just a reminder, Advanta IRA does not provide investment advice. We don't endorse any particular products. The information and materials that we present in our webinars and our seminars are for educational purposes only. We encourage you to consult with an attorney and accountant, other advisors before entering any type of investment. If you need referrals to those types of individuals, we are more than happy to assist you as well. Just a little bit about Advanta, anyone who might be new to Advanta, maybe even new to self-direction. We've been in the industry almost 20 years. We are one of the premier administrators of self-directed IRAs across the country. And the only thing we do at Advanta is administer self-directed retirement accounts. We assist people investing in different alternative assets, like some of the ones we're going to talk about today. We currently hold over $2.5 billion in assets under management for our over 12,000 clients that we have. And we really try to set ourselves apart in two ways. One is the customer service experience that you get with a dedicated account manager. So you have one or 2 points of contact at the firm for any questions you have regarding your retirement account. And our educational offerings, the webinars, the seminars that we provide, like the one that you're listening to today. We have a very extensive video library. You can go to our YouTube page. We record all of our webinars, including the one that you're listening to today. If you ever miss a webinar or you can't attend a live version, you can make sure to catch that recorded webinar on our YouTube page, usually within a day or so of the live event. We also have a podcast, not listed here on this particular slide, but we have a podcast, The Alternative Investing Advantage, hosted by my colleague, Alex Perney. The links to all those podcasts are also on the Advanta On Demand YouTube page as well. So again, just some of the basics of kind of self-directed IRAs, maybe why you haven't heard about this, if this concept is new to you, or maybe it's fairly recent that you heard about self-directed IRAs. The reason most individuals are unfamiliar with this investment option is that most IRAs are administered by banks or brokerage firms who offer you only those products, only those investments that they sell or that are available on their particular platform. But IRS regulations allow for a much broader range of investments that you can hold inside of a retirement account. So the IRS simply says you can't buy life insurance, you can't buy collectibles, and you can't self-deal. So you can't lend yourself money, you can't buy homes and things that you want to live in. So I'm not going to get into all the rules today, but happy to talk with you offline. So the IRS regulations are very, like I said, the restrictions are very small. No life insurance, no collectibles, and no self-dealing. But you can invest in a wide variety of different assets. However, each custodian is not required to allow you to invest in anything that's possible. So each custodian can restrict on their own what types of assets they're willing to hold. That's where the banks and brokerage firms have made the decisions to simply only hold mutual funds or stocks or other publicly traded securities. You need a firm like Advanta to get outside of those options, and take advantage really, in the real estate market. And we're going to talk about real estate a lot today as we talk about multifamily real estate investing. When it comes to investing in real estate, we have clients who invest in rental homes, commercial real estate, could be rental, short-term rentals, long-term rentals, fixer-uppers. Somebody could be investing in a rehab project through their IRA account. It could just be raw lands. duplexes, et cetera. Again, what we're going to focus on today, though, and our guests are on to explain, is really the multifamily property, multifamily aspect. We have seen a tremendous increase in the number of people looking to invest in multifamily probably over the last 4 or 5 years. So that's why we like to bring in individuals that are again, experts in the industry or boots on the ground to really explain what is going on with multifamily, kind of where it might be headed, and things to look out for. So we're happy to have our guests on today. I think as we talk about the investments, you look maybe going, if you just keep in mind what was on that previous slide, you have rental properties, you have rehabs, contrasting those with syndications or private placements or multifamily. So it's we have both active and passive investments, and you can certainly make both types of investments inside of your IRA account. But I think if you're looking at this webinar, you're either new to self-direction or you're kind of at a crossroads, you're not really sure which direction you want to go in with your investment. A good analysis is to figure out, am I an active investor where I want to be more in control, more hands-on? It's going to eat up a little bit more of my time and my energy. I'm going to be responsible for all the details. That's the downside. The upside, though, is again, you're in control. Maybe you're driving a higher return. But somebody who could be more active. Or on the flip side, you might have people who are more passive, who tend to the syndications and the private lending and the multifamily investments because there's not as much time commitment. They're not going to be bothered by the day-to-day minutia of the investment. So they simply get a check each month, satisfies their or each quarter, the money coming back into their account, they're happy. But they don't have as much control when you're a passive investor. You don't have maybe a say in the decision making that are made by the managers of the investments. I think, again, if you're someone who's new to self-direction, maybe just new to real estate investing in general, it's a really good exercise to have with yourself. Is kind of what investment might make the most sense to you. Now, again, we're joined by 3 individuals today from JT Capital. We have Deepa Akula, Sapan Talati, and Denver Lobo. We're going to talk about multifamily investing trends here in 2024. And before I turn it over to them, I want to make sure that again, if you're listening live to this webinar, you have the ability to ask questions, either myself or one of our 3 panelists as well. So get your questions typed into the question box. I will make sure that I follow those and look at those as we go along. So this time I'm going to turn it over to 3 of you guys over at JT Capital, and I'm going to see if I can pull up your slides here and make sure we. All right, Sapan, I'm going to turn it over to you and let you go. Like I said, I will monitor the question box as we go along, and just let me know when you need to change the slides or I guess advance the slides.
Absolutely, Scott. Thank you. Thanks for having us here. Welcome, everyone. I'm Sapan Talati, co-founder and managing partner of JT Capital. It's our privilege to guide you through today's insightful webinar. Joining me today are Denver Lobo, principal of our capital markets team, and Deepa Akula, managing principal of our retail investor relations team. Whether you're familiar with our work or new to JT Capital or self-directed IRAs, we're excited to have you here with us, and we're excited to be here. I want to talk briefly just about on the next slide, we've just got our JT Capital advantage that we pride ourselves on. Firstly, we focus on institutional grade assets. Our strategy is to zero in on high quality institutional assets. This isn't just about growth, it's about sustained growth and enduring value. We're not just participating in the market, we're carefully selecting assets that stand the test of time, and we'll dig into more on the marketplace and the value of the test of time. Next, we emphasize on active asset management. It's not just to acquire great assets, we actively optimize their performance. This involves employing data-driven insights to enhance the return. Our approach here is hands-on, constantly seeking ways to improve and add value as well as mitigate risk, which is finally strategic risk management, which really is at the core of what we do. Our team is committed to maintaining risk control and consistency in all of our endeavors. This does not mean shying away from ambitious projects. It just means simply we're intelligently navigating them to produce outsized returns while simultaneously mitigating risks and safeguarding our investments. This 3-pronged approach, which we call the JT advantage, is really what sets us apart and drives our success in the multifamily real estate sector. I'm going to turn it over to Deepa, who's going to start talking more about the current environment and the marketplace.
All right, thank you. So as Scott introduced me, I'm Deepa Akula. I am the managing principal and at JT Capital, And I'd love to take you over as to what makes us different at JT Capital. We are a very low volume shop, and we are very selective. As Sapan mentioned, we are very selective. We only concentrate on institutional grade assets in submarkets that we are very familiar with in Florida and Texas. But I want to take you through our 4 pillars, which is the first, principles thinking. We are highly focused, so our knowledge base and our focus is only inch wide and a mile deep. So we are super focused on markets, and also the assets that we focus on is institutional grade assets with, institutional grade assets with really high markets with job growth and population growth. And as a small team, adaptive innovation, we innovate, we pivot. We have seen in 2023 as to what markets can do. There was rent softening in the rents, and we saw little bit of an oversupply, and we had to adapt for lowering occupancy. And as a small team, we have that capability of pivoting fast and adapting to the changing market landscape. And operational intelligence, we are super focused on data and being data driven. We have CoStar, and we have subscription to RealPage, which really gives us a lot of insight on the pipeline as to what's coming online. And depending on that, we can pivot, and we are very data driven. And Sapan already mentioned that we are very risk averse in their management. We are very conservative. We're very passionate about generating double-digit returns, but that is also to say that the market also gave us the opportunity to make sure that we have lots and lots of projects that are really good. And in 2021 and 2022, nothing was penciling out. But right now, we have a lot of projects that are penciling out, and going after the projects that are operationally very efficient and working in those markets is really our focus. And Scott, could you please advance the slide?
Yeah, Deepa, I can advance. I did have one question that popped up, though.
Yes.
I'm not sure if it's a question for me or maybe for you. I'm going to ask it to both. But one question says, does an investment have to demonstrate risk? And what is the bar for that? So I would say in general for an IRA account, an IRA to make an investment, that's why I don't know if that's where the question is going with the IRA side. Don't necessarily have to demonstrate risk, but it has to be a fair market investment. I guess maybe all investments to some extent have risk. I don't know what the bar for that necessarily is to the person asking the question, but it does have to be from an IRA perspective. Something that every fair market person, kind of a fair market actor would have done. People acting. If I always use the example, if you're going to lend money to your sister at 1% because she's paying you back, maybe there's not as much risk there, and that's the danger involved because you wouldn't do that with a third party. So maybe that helps answer the question from the IRA perspective. But I guess from your guys' perspective, obviously you want to mitigate risk. You can't necessarily eliminate it, but how do you go about, deciding how much risk is acceptable? And I guess what is your bar for acceptable risk?
I could take that, and there's a slide on risk-adjusted returns. I'd say our bar for, well, I wouldn't call it high or low, but I think from a risk-adjusted standpoint, we're very risk-averse. One of the focus on institutional grade quality assets, we're looking generally for newer assets, maybe vintage 2000s and newer, largely looking to avoid classes C, maybe even some lower B. We're looking at avoiding dated, what you call vintage assets that may have deferred maintenance. We're investing in demographics or regions that demonstrate a comfortable, I would say, income, general income basis. So we're trying to, or we're looking to mitigate risk from rent payment exposure. Generally, we have a high degree of collections across our assets by focusing on that. we focus in areas that have and are able to demonstrate strong job growth and sustain jobs through different market cycles. So we're not looking at just a bull market, but also when we're in a recessionary period, what does that market look like? We're looking for good supply demand, so we focus heavily on, well, I shouldn't say heavily, but just we have a focus on understanding the new permits, new construction starts, permits precede new construction starts, and then you have the deliveries, which we're currently seeing as one of the headwinds in certain markets, or many markets, but not all markets, in terms of deliveries. And then of course, just the active asset management component. So it's not just property management, it's not just having an on-site team going out there leasing up the assets and providing customer service to your residents, but it's also the performance and ensuring that performance continues to remain in place, but also exceed, and we're continually looking for opportunities to perform better. So there's a lot of different areas in that risk side that you can control. Regulatory is another one, often overlooked and not spoken of, but understanding the local regulatory market, even on a national level, some of that will impact your operations. Something as simple as, I believe it was earlier this month, legislation was passed that's not written into law just yet in terms of reinstating certain tax write-offs and benefits for businesses. The big one in multifamily potentially could be reinstating the full cost segregation, which means you could potentially write down 100% day one, which we were previously able to do, and that's been diminishing by 20% for the last 2 years. So those are certain things, just understanding that and implications of that with how that investment would be treated. But again, just going back to the asset itself, we're looking at how do we best mitigate risk, going back to we're risk averse, at least for our team. So, we're generally not going to provide you the highest return, partially because we're not looking for, assets that can get you a 20+% yield, but then the risk associated with that is just something we're not comfortable with. We'd rather select something that's much more consistent on a return basis, something that we feel comfortable with, that we can deliver, and at the same time aligns to our investors, I would say investment thesis or comfortability in terms of risk, duration, and of course knowing how much they're invested in maybe private investments relative to other investments as well, plays a large role. You don't want anyone to be overloaded or overweight in any particular sector. So that's just a long-winded response, but just wanted to give you an idea of how we're thinking about it.
Okay, yeah, and there was a follow-up just said, have there been, and I guess the question was mainly SDI IRA focused on that, but says, have there been any issues in the past with the IRS demonstrating risk in the multifamily portfolio, thus putting the SDI IRA assets in jeopardy of penalty? I have not seen anything like that myself. No, I think most of the 100% of the multifamily investments we do are people investing their IRAs with other people who are not related to them. It can be tricky to make investments with other family members inside of a multifamily structure as it is. So, great questions. Yeah, great. I'm sorry, yes, you have something to add?
We haven't seen that either, or at least that I'm aware of. We do have a number of investors that come in from the SD IRA path, and we've had that for a number of years and have not seen anything at least related to that, or at least that I'm aware of.
Okay, great questions. Like I said, anyone else on listening, please keep those coming, but I'll let you guys advance the slides, so go ahead and take it from here.
All right, great questions. Thank you all. And most of us, if we are here, we know the advantages of investing in multifamily, and the four big ones are capital preservation, because you have asset-backed investment. It is a tactile. It's an asset that is there. It's brick and mortar, and it also helps with capital preservation. And the JT difference of going after institutional grade assets, newer vintages, and being focused on markets that have strong job and population growth and higher median income, also helps with capital preservation and stable cash flow. With like any rental, multifamily real estate, there are multiple tenants that are paying, and there's stable cash flow if we are able to manage our asset and manage the occupancy, and that's all goes back to our active asset management and diversification. And for you guys that's listening out there, you could be in stocks, bonds, mutual funds, and this is a really great way to expose part of your portfolio to real estate. And if you have a job and you really love that job and want to keep doing that, but also want some of your portfolio to be real estate, this is a great opportunity to just invest in multifamily passively. And you also get some tax benefits by investing in multifamily. Sapan just alluded to cost segregation, and there was some legislation that will hopefully reinstate the bonus depreciation. But please talk to your CPA. I'm definitely not a CPA, but there are some tax benefits. You can offset the income that you make from passive income with your passive losses. So there's something called cost segregation, and there's definitely tax benefits for investing in real estate. Can you go to the next one slide, Scott?
Sure. Yeah. Before I go, I did have another couple great questions pop up. Someone asked you to talk about your really you focus your investments in growing areas. Like, are there specific states that you're looking in currently? Like, any of the question was, are any in the Southeast United States? But are they looking for certain states, or is it maybe do you look more specifically into cities where growth is? It's not enough to say, hey, yeah, we really like the state of, say, Kansas. It's like, no, I want the actual specific city is where the growth is. Yes, when you're looking for geographically, what are areas where you're currently looking at?
I could take that one as well. Yeah, it's a really good question. So we've got two thoughts on that. Generally, when we're looking at single asset acquisition, we focus in our niche. We're a believer in really knowing our backyard. And part of that's just Central Florida markets. We've been in there for a number of years. We know a number of the buyers, sellers. We've got strong relationships in the market. We know how different groups are operating it. So as we're touring an asset that might be of interest, we've got a really good feel for how it's been previously managed. And also likely we've been tracking that asset for a number of years. As we continue to add data into our database on deals that we like, that we either passed on for various reasons that may have made its way back into the marketplace. Whether it was on market listing or a private listing or off market. And so we focus on certain marketplaces, again, just going back to knowledge base, ability for us to pull resources together, referring back to the previous question in terms of risk mitigation. I think there's a lot to be said to have that type of knowledge that goes a little bit deeper and beyond just your databases in terms of whether you're subscribing to well-known databases such as CoStar, Yardi, et cetera, which are great and informative. Beyond that, there's that interpretation of that data. What does it mean? And then also being in front of it a bit more. The other school on our end is we also have a fund. And so when we're investing with the fund, slightly different, because you're investing in a different part of the capital stack. You're not actively engaged in the property management of the asset, but you're more of an investor coming from a slightly different structure. And so that affords us to invest and be involved in certain markets that we have a lot of knowledge on, but maybe not the boots on the ground resource capabilities that we'd like to have. That's not to say we don't have the capabilities, but just maybe our preference doesn't really meet where that comfortability is when we do a single asset acquisition in this market. But we have good knowledge where it's hitting the metrics. This would be a very sound investment for our fund, and it would make sense for that on behalf of our investors. So that's how we look at that. It just really depends on how we're investing in, and therefore which market.
Okay, yeah, thanks for the answer. We have a couple other questions that popped up. I'm going to leave those for now, let you get back to the presentation. I think you might touch on some of the answer or some of the questions, have some of the answers to the questions being asked. So I'll turn it back over to you guys.
Thanks a lot, Scott, and thanks for the great questions, everyone. Just keep them coming. We love engaging with not only y'all, but also our limited partners and our other partners as well. It improves our management of the asset. It brings a lot of things to light, and we love having those conversations. So thank you for the questions. When we look at the landscape for 2024, we have not been this excited in a long time. And so, hence our reason for being here. These are 4 topics that we'll touch upon in this presentation. The first one is just the sheer amount of pent up demand and supply. And I'll give you numbers where in 2021, there was a record number of multifamily transactions in the market. That was around 230 billion. In 2022, that decreased to about 200 billion. In 2023, that number stood at 60 billion, which is around a 70% drop. Does that mean that multifamily owners are not looking to transact? It doesn't. It actually means that either they weren't able to find the financing or weren't okay with how high interest rates had gotten. The whole topic of how high interest rates have gotten and how fast they've gotten there has decreased multifamily values, but buyers and sellers aren't sure of how much they have decreased. And when we look at this opportunity, we look at the Great Financial Crisis in 2008 and 2012. If you were looking at a house at that point of time, you saw houses on the market for $30,000, $50,000, and there was a large reset in the single family space in the real estate space. In multifamily, we have seen the largest shock of prices that we have seen in the last 10 years. Commercial real estate prices from 21 are down around 20%. And so if we were to look back at 08 and say, do you want to invest in single family? We would say yes, absolutely. That's what's happening right now in multifamily. And we're right there. We've been buying these assets for a long time and managing them. And so we're getting this discount that we haven't seen in 10 years. And so we think it's a golden opportunity for the next 12 to 24 months to purchase really high quality assets and get a good return on it. The last portion of this is our competition and who we're competing with. And as you might have heard also, it has been a rough year for regional and community banks. Public perception of community banks early 2023, names like SVB, First Republic had got hurt just because of their sheer size and allocation towards commercial real estate. Almost 70% of their assets are invested in commercial real estate that, as I said slightly earlier, is now down 20% in value. And so these banks have to really readjust their balance sheets and their portfolios to be able to enter the market and start originating new loans. And so while they are on the sideline, JT Capital and funds like ours are raising money within funds to actually help sponsors and help multifamily owners get their deal to the finish line. So we come in and we kind of are acting as the lending institution in this void that has been created by community and regional banks, so that we can come in and help these owners get to their finish line. And in terms of the regulatory environment too, there's some regulations on banks that have just been introduced, one of which is Basel III Endgame, which is going to increase the amount of capital that banks need to hold on their balance sheets, again, further increasing the cost of capital for banks, which makes it even harder for them to compete against us in the space. And so, to summarize, we are extremely excited for 2024, not only on the single asset multifamily side, but also the fund side. And I'll pass it to Deepa to kind of dig a little bit deeper into the supply as well and what's happening in that space.
Yeah, thanks, Denver. And you guys, we've seen a lot of supply. The market was running hot. The capital was cheap in 2021, even 2020 up to 2022, right, when the Fed started to increase interest rates. And there was a lot of interest in multifamily assets just from investors too, because because of inflation, the rents were going up, and because the capital was so cheap, there was a lot of construction that came online, a lot of permits being pulled, construction starts. And since then, because of the increase in the interest rates, the starts and the permits have slowed down a lot year over year by almost by 32%. And we are going to see a lag in the units coming online. So maybe in 1 or 2 years, there's a lot of demand. Currently, there's a lot of demand. The demand has not gone away, but the rents are softening because there's a lot of supply. Everybody's got the same idea, right? When something is working, everybody wants to jump in and construct more multifamily units. So, and right now, there has been a drop in year over year, decline in year over year, the number of units that are being, the construction starts. And we're going to see the demand and supply kind of even out in the coming years as we go. And hopefully in general, by 2026, we're going to see that the rents are going to go up. And that has already been happening in a few submarkets. It's very submarket based, but overall, we're going to see the rents go up. And it's already started in some markets in last quarter of 2023, surprisingly, in some parts of Florida. So, with the supply coming to a limit and the demand staying steady, we're going to definitely see rents go up. Could you go to the next one, Scott? Thank you. And, this was also very caught off guard, but a lot of people, we don't think about how much the interest rates really affect, because since 2008, we all kind of got used to living in this really low interest rate environment. And we are a millennial, then, most of our adult life, we've lived in this environment where the interest rates are really low. And right now, there was an article in Wall Street Journal. Right now, it's like the worst time to buy a house because the mortgage is like 52% higher because of the interest rates. So this also just adds to more demand. In 2021, because of COVID, we saw a lot of household formation, which really increased the demand. And that has slowed down in 2022. And with the single family market being so hot right now, the prices in the single family market for the houses have really not adjusted as much as the multifamily. So they're not as affordable. With the demand growing and the supply slowing, we're going to see it's going to be a good year going ahead for good opportunities. And with the, I don't want to steal the thunder. There's the next slide where it says that we have seen the in the price shocks and everything are in the rearview mirror. But with everything that's gone because of the interest rates hike, now that the inflation is cooling down, the Fed's thinking about cutting down the interest rates. And from this point on, it's just good news, barring any big economic shocks. So I'll give it over to Sapan for the next one.
Yep, and Sapan, before we go, there was again another couple questions came in, maybe some quick hitters, quick answers. But one of them is, what are the biggest challenges in the multifamily market today? It says, i.e., restrictive banking requirements, property management issues. You've obviously touched on supply and demand as well. So has it been the banking, or has it been more the supply or demand that have been kind of the bigger challenge to, I guess, as 2023 ended and as we're going into the start of 2024?
Yeah, happy to jump in on that. It just depends on where you sit. I think as a buyer, price discovery, right? Deborah mentioned it's rather difficult to ascertain what the current price might be. Are we really trading at a 6 cap? Are we trading at 5.5 cap? I'm going to generalize, but I'd say 80% of the groups that would probably transact are not transacting or transacting privately. That pricing is never hitting the marketplace, and it's therefore not a data point. Maybe the 20% or so we're seeing are transacting and why. There's going to be some bucket of that due to a maturing loan or maturing rate cap, and financially or fiscally, it just makes sense to transact at that lower price than either have a capital event, whether that's a capital call or reinvestment of capital, maybe from some of the liquidity that they have or they've saved up. The other part to it is the banking. You're absolutely correct on that. The rates are high. It may not model out to hold on to it for another 3 or 4 years or a little bit longer. Again, why? Maybe their current investment, whether it's a fund, has a mandate, meaning there's an end or terminal point on when that capital needs to be returned. So it's the fund is run, maybe towards the end of its life cycle. So there's a variety of reasons, at least from that end. Other parts to it are other things that we haven't discussed, probably a broader conversation. Insurance. Insurance has been on a tear for several years. It's probably made the news cycle more so in the last 18 months than we've previously seen, but we've been seeing these increases for a number of years, up until a point where it just became a big shock. I would say. And so that rising cost of insurance is playing a role in your returns, and also your loan proceeds, which kind of comes back to refinancing may require a lower leverage point. And with more equity in the deal, some of these deals are not modeling out for the equity that's being placed into that deal. And so with that gap or so, as we're calling it in the funding, where we're kind of like the smaller banks have vacated, that's opened up a lot of opportunity, and we can probably just go into that next slide and open it up. But opened up in that capital stack where maybe between the 60 and 70 percent LTV, you have groups like ours that are able to invest in there, have a bit more of a predictive outcome, because you're senior to all that other equity in there, and coming in right behind maybe the senior note. And so when I say predictive, it's not guaranteed, but you're just in a safer position because you've got equity cushion that sits behind you. But why don't we go on to that next question, just in the interest of time?
Sure. One of the other questions that popped up, I think I can probably take this. Once someone said, are limited partners considered actively managing, or do they remain at arm's length? I mean, for these types of investments, that's what a limited partner is. You're putting in the capital, but you're entrusting. That's kind of that slide I had, active versus passive. You really are passive. The general partners, the syndicators who are in charge of the project, are the ones that are going to be making that decision. So you're not considered actively managing at all. In fact, that's kind of what a truly limited partner is. Another question that came up, I think maybe also just to help people understand, someone is asking, does JT Capital take the, when you bring in your investors, are you taking the funds in to purchase multifamily and manage them, or are you taking the funds in more to provide loan to other multifamily member groups? So are you really providing the capital for other multifamily, or are you actually going and purchasing the properties yourself?
Great question. Denver, you want to take that one?
Yeah, for sure. So traditionally, we did the former, and so we raised capital to purchase single asset multifamily. So we'd go in there, we'd buy a 200-unit apartment building, we'd operate it for about 5 to 7 years, and then we would exit, and we've done around 27 of those. Because we have, all the themes that we've been talking about, the financial tightening that we'll go a little bit deeper into as well, we've seen a huge opportunity for us to be able to also invest and lend to multifamily groups. And so we have an all-weather strategy where, in the good times, we look for amazing locations and amazing assets, and we're doing that. And in the not so good times, we're still doing that. However, we have a different strategy, which is kind of encompassed in our fund, that allows us to go out and find operators that are operationally efficient with their assets. So for example, they have assets that are 90 or 95% occupied with tenants in there. So they're running it really well, but interest rates have impacted their overall business. And so we see an opportunity to come in there, help them through this 24 to 36 month period, and get them to that point of the finish line where they're selling the asset at today's value, much further on. So we get kind of today's values pricing in 3 years, which hopefully is much better for the multifamily owner, much better for us and our investors as well. So we deploy this in 2 strategies, which are kind of all-weather encompassed.
All right, yeah, if you guys want to keep going on this, I have a couple other questions. We'll kind of maybe hold them more towards the end and let you kind of keep going through the slides. You need to go on to the next one?
Sure. And I know, just again, kind of going back to time, we talked quite a bit on the risk-adjusted returns. One point I just want to make here then is just really we're just seeing a higher allocation, particularly from family offices. We're even seeing that on the institutional side, really into similar opportunities that we ourselves are seeking. And then within that opportunity, we've pretty much identified a niche that seems to really work where it's just less competitive. We can go on to that next slide, which is the expense shocks, which we've talked about, right? Interest rates have gone up at quite a shock rate. It's certainly impacted value. It's impacted cap rates. It's impacted a lot of that refinance. One way to think about it is, a lot of groups in 2019, 2020, 2021, 2022 were buying at low interest rate and therefore getting a little bit higher loan or a little bit on a higher leverage side. And then the thesis or the business plan on that may have been to refinance out some of that equity, or it was on a floating rate with a short term, and then we'd refinance that into maybe a longer term, or possibly exit. What ultimately ended up happening with this shock is that the rates went up so quickly that those balance sheets, when it came time to reprice it, really were not in a good place to reprice. And then again, the things I'd mentioned, right? There's capital that needs to come in. Now the model doesn't make sense. The rates are a bit higher than where they'd like to be for the refi. Again, now they can't get the capital. Again, it depends on the location, type of asset. And so a lot of these shocks are now in the rear view mirror. We're able to price that in. There's strong sentiment that we're going to see a decrease or rate cuts. We ourselves are not pricing in any rate cuts when we're modeling deals. We're still looking at it as interest rates are going to stay flat where they're at, taking that conservative approach to it. The other shock, as I alluded to, was earlier as well, is just the insurance. The cost of insurance has risen quite a bit. It's no longer a shock. We're still expecting insurance to continue to increase, but it's a lot more predictable in terms of at least pricing that into your model. The unpredictability is where is that going to land? That no one knows, but again, you have visibility towards that. With that, I'm going to hand it back over to Denver.
Yeah, so we've talked a lot about tighter financial conditions, but it's always good to see it in more picture form and graphs. And I'm not sure if this presentation is shared with you, but I'm happy to share it with you if you email me. So the 2 graphs on the side essentially show that lending standards have tightened. And if you see the first graph on the top right, it shows you that lending for commercial real estate as a whole is down, let's call it about 30%. However, a big player in this market was your smaller regional banks. And for example, they typically do any from 35 to 45% of annual net new loans in the market. Last year, that value dropped almost 75%. And so even within this negative 30% drop of lending, there's other lenders much bigger in the multifamily space that have retreated. And so that's where our fund comes in to kind of solve and save the day for some of these operators. The second graph at the bottom shows that the amount of banks percentage-wise that have tightened their lending standards is as high as it was in the pandemic. So if you think about that and think about how how much this landscape has shifted from a very normal environment pre-2019 to the pandemic to post-pandemic, and now you can kind of see the magnitude of shifts going on. And so an article where BlackRock, one of the largest holders of real estate, was saying that's where private credit funds have come in to solve that gap in the market that long-term relationship between us, per se, and the borrower can often result to a more efficient process for negotiating amendments and having it be a win-win situation for both the multifamily owner and us. The ability, the risk-adjusted ability for us to provide our investors as well. Sapan touched upon family offices being a much more prevalent investor in this space, and it's because the quality of the asset's gone up, but instead of the yield going down, the yield has actually stayed relatively high. We're able to kind of offer that to our investors. And if you go to the next slide, one of the areas that we see as a very large opportunity is something called a funding gap. And so explaining this a little bit, when you own your own home and you go to do a cash out refinance, what typically happens is your home is appreciated and you get more money out of the deal. So you get more money in your pocket and you can kind of do with it whatever you want with that money. In multifamily, just because values have dropped, if you go to do a cash out refinance, it's actually not a cash out, but a cash in refinance. And that value is currently $21 billion in the US, and it's expected to grow to $45 billion. And so there's a very large need for capital to even do that refinance and help these current owners and operators of multifamily along. And again, that's how much of an opportunity set we have compared to the small amount of funds that that other private equity firms have raised to kind of fill that gap is minuscule compared to how large the opportunity set is. And therefore, we get to be very picky and choosy as to who we invest in, making sure that the sponsor that we invest in is just extremely high quality. The asset is an asset that we have an unfair advantage to play in and ultimately deliver outsized risk-adjusted yields to our investors. You touched upon a lot of these, Scott, so I won't go through every one, but investing in multifamily real estate, either through single asset or funds, is just using your SIDRA is just a great way to invest because of the tax advantages, the diversification you get, and then also the estate planning benefits. And I'm happy to kind of have a follow-on conversation as well in the interest of time and really getting to some of your questions.
Yeah, thanks, guys. Yeah, I had a couple other questions pop in, and maybe we'll get through those and let you kind of finish up kind of about next steps. And obviously, if people want to reach out to you more as well. One question that came in earlier, I kind of saved it, was kind of what the fee structure is to an investor, and somebody else was asking kind of what is the average income kind of return for investors and what's your goal for return, as well as kind of minimum investment amounts. Again, we try to make sure this is kind of an educational presentation, but obviously there are people asking those questions. We want to make sure we get those answered for them. So maybe talk a little bit about how your returns are structured or within your fund. I mean, some people, is it similar to how other multifamily projects are done since you're doing more of a lending fund? Maybe talk just a little bit about that, your kind of your fee structures and the splits between investors and yourselves.
Denver, you want to jump in on that one?
Yeah, sure. I'm happy to take it. So in terms of fees, I'll start there. Try to be as less prohibitive as possible. All these fees go towards running the fund, making sure these assets are good within the fund, and the analysis and due diligence that goes into all of them. So what we charge is a 1.25 management fee. And then there are fees for transactions and just admin fees. And then in terms of returns, what we do is we split it based in two share classes. And so for one of them, for investors that want a more of a cash flow type account, we have an account that has a 12% preferred rate of return on it, and the minimum investment size is $50,000. And we have a separate share account that has more of an upside to it. So for investors that want a quarterly payment plus an equity upside at the end of the day can get access to our share B class, which is 10% preferred return plus an equity upside benefit. And typically that's shared 70% to the investor, i.e. you, and 30% to us.
Yep, and following up, kind of one question, I guess, and this maybe for the on the investment side too, was when you're looking to make an investment from the fund into a, say, a multifamily with a multifamily operator, are you typically investing on individual properties, or are you allowing you have maybe an investor who's got multiple properties? Are you willing to lend more on their portfolio of different properties?
Oh, we're definitely taking a look at the assets themselves, Scott. And we're taking a look at their portfolio on their performance, but we are lending or investing in one asset. Guys, please jump in.
Yeah, I mean, there's several filters and criteria. I think for us, when we're looking at it, we've got a pretty lengthy due diligence checklist, on the individuals that are sponsors, almost a little bit more invasive than maybe most groups out there that are lending. But that's by intent and design. Goes back to that risk-averse nature. If we're investing into one asset or into a portfolio of that it's owned by an owner, operator, sponsor, borrower, it needs to make sure, or we need to make sure that we're comfortable with it. We're comfortable with the equity exposure they have. We also want to make sure that our check is not adding additional leverage that puts us in an uncomfortable position, or that they're over leveraged. We want to understand their business plan. Do we feel comfortable with their business plan? And of course, we're going to make sure we've got control rights there as well. In the case, hopefully it doesn't happen if things didn't work out the way that it was intended to. We're really focused on principal protection, more so than the upside, if you will, when we're looking at it through that lens.
And the last thing I'd also say is, the idea of a fund is for one investor to get access to multiple deals, and that also means multiple sponsors as well. So we will, be mindful of how much of a percentage kind of goes to one sponsor, to just make sure that the investor is kind of getting their best blended rate of return and a diversification play, not only on asset location, but also business strategy and operator as well.
Yep. Well, like I said, Deepa, Denver, Sapan, thank you very much for your time today. I have obviously your contact information on this slide. I guess last question I've got is, you looked at 2024 years. We're almost a full month into the time of this recording. What do you see change interest rates? How if interest rates do go down as they maybe are expected to a little bit with inflation easing, how do you see that impacting your fund and kind of getting in that lending in that funding gap? Are you still going to always have a funding gap with certain syndicators and certain investors?
Sure. I think at least for the timing of our fund, we see this opportunity probably exacerbating a bit more and giving us a bit more of an opportunity in terms of maybe the deal volume. We've got an overwhelming amount of deal volume. There's one caveat that the fund's not really targeting I would say ideally syndicators as a whole. We're really looking for, and if it is, it's because there's significant experience there. We're really focused on experienced operators that have been in the industry for a number of years, that have a demonstrable track record that we can get behind, and have an active portfolio that's fairly significant. But yeah, we think that even if rates were to come down sooner rather than later or later, the opportunity is going to be there. If rates come down even 75 bips, it's not going to simply solve the problem overnight or as quickly as maybe a lot of folks hope. So there's absolutely going to be a need, for the time being, and that's why we see this as a window of opportunity probably over the next 12, maybe 18 months, and potentially out to 24 months.
All right. Well, again, thank you all very much for your time. Again, if you're listening to the webinar, you've been listening to the recording, here's their information. You can find their website here, email address, and the QR code to get in touch with them. Again, if you're looking for more information on the self-directed IRA, here's my information. I'd be happy to answer questions for you about SD IRAs, getting started, how the process works. If you're looking to make an investment similar to what JT Capital offers, what that paperwork, what that process looks like, always happy to speak with you and walk you through that process. So again, Deepa, Denver, Sapan, thank you very much for your time today, and we'll look forward to having you on again in the future.